everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. In our last recording, we talked about how storm clouds were brewing for the market. Well, they're still there. Bitcoin made a classic Elliott Wave triangle retracement. Interest rates appear to be waking from their 2-month slumber, and the start to this week can be summarized in one word: doji. Let's take a look at the charts. At the time of this recording, it is 2:30 a.m. Eastern Time on Tuesday night / Wednesday morning, and currently the futures are up 4, so basically flat. Well, in the intro, I mentioned that the start to this week could be summarized in one word: doji. Now let's take a look. We actually had a doji all the way back on the 16th as we approached that 420 level, the 161.8% extension of the zigzag in the wave 5. And then the last 2 days, we've had dojis as well. Basically, we've been in a consolidation for over a week, right as we got to that 420 level. But a troubling thing is when we take a look at the volume. I also mentioned in the intro that the storm clouds are still there. Yeah, and they're getting a little bit darker, I think. When you have 2 dojis like that on back-to-back on low volume days, definitely worrisome, or at least something to pay attention to. Take a look at the moving averages. You can see that we are still above the 10-day moving average and consolidating underneath a major area of resistance, so those things could be considered positive. We look at the DMI, and it hasn't broken down, but it's not as supportive as it once was either. But I do have another storm cloud to add to the mix here. Take a look at this. This is margin debt to nominal GDP. Think of it as a measurement of risk-taking, right? It's kind of a sentiment indicator. How much risk are people willing to take? How much margin are they willing to take on? Debt, if you will. Well, when you take a look at this, when margin debt goes vertical, hasn't been so good for the market. Here's one of those vertical moves in March of 2000, and if you've heard me do any recordings, you know I don't like it when things go vertical. And I think you know what happened in 2000 and 2002. We had a pretty big 2-year down market. Then we had another peak in July 2007, which was followed by the great financial crisis in 2008 and 9. And have a look at where we are now. We may be more vertical now than we were at either March of 2000 or July of 2007. So another one of those things to keep in your mind when you're making your decisions on how much debt you want to take on or margin, or how long you want to be in your portfolio. So taking a look at the US dollar, we had looked at that in a bit. You can see that after completing that zigzag to the upside, we've retraced the entire C wave impulse, and that would have finished up right here. So we retraced the entire C wave. So that means we're probably coming down to this area of support, which would make sense because that retraces the entire zigzag pattern to the upside. Not a big fan of the dollar getting too weak. I know that all the countries want to race to devalue their currency. It's better for international trade, etc. with the exchange rate, better for profits, bottom lines, all those things. But it just doesn't show good economic strength when the dollar gets too weak. And so this march to the downside, I think that's concerning as well. When we take a look at interest rates, also mentioned in the intro that maybe they're waking from their 2-month slumber, and you can see what I mean by today's bar. Big move to the upside. Now, we had a wave 4 labeling here. It was only a 20% correction. Elliott wouldn't even really consider a 20% move or correction. But when we take a look at the 30-year, at least it made it to that 23.6% fib level, which that makes more sense. But if interest rates are going to start to creep back up, the market didn't really like that before when they were going up. So we'll see if we get any follow-through to today's little bounce higher in rates. Will that affect gold? Probably. If we take a look at the chart of gold, we mentioned in the last recording that we moved finally above this area of 165. Finally broke that long resistance area. But look, we've also hit a fib wall, if you will, at the 38% fib level. And that kind of stopped the move in its tracks. But support is real close, right? If 165 holds, we could still bounce higher. We could move up to a 50% or even a 61.8% wave 4 and still stay in this 5-wave labeling to the downside. But 165 is going to be very important as a level to hold. Can it do that if rates start going back up? That's going to be the interesting thing. Looking at the SLV, and it has broken above. It doesn't have a 5-wave labeling pattern, but it's holding above its level at 24.2. So they're both precarious, right? Both gold and silver have broken above some longer term resistance, but just barely, and they're just holding in there. They haven't surged higher, which you would have liked to have seen if they're going to continue that move. Now, we're looking at the IWM. We haven't looked at the Russell in a while. Seems like it thinks it's January again. Remember when we talked about the January effect and how small caps tend to outperform in the month of January? Well, looking at the IWM, it's had a pretty nice move here this week. While the market has been going sideways and consolidating, the Russell's been moving back to the upside. But take a look at the labeling there. Is this a head and shoulders pattern? We got a pretty good left shoulder ahead, but that right shoulder kind of fell apart. It looked like it was forming pretty well here, and then we came down. I left it here because some might argue that, well, the move here is just kind of got a hump in the right shoulder there, and we're just exactly at the level that we were on the left shoulder. And that's a valid point. So before we can say that this head and shoulders pattern is disqualified or not going to work, we have to break above that 230 level on the IWM. If we look at the Elliott wave pattern, you can see that we are in a wave 3. And looking at the DMI though, the ADX just is not interested in this move. So you've had 5 days to the upside. The ADX is curled down for all of them. Positive directional indicators moving higher, but you would want to see that ADX at least show some sort of life. Maybe a break above the 230 level would help that, but so far not much support from the DMI on the Russell. And then Bitcoin. I think there was a little bit of misunderstanding in the last recording when we talked about Bitcoin breaking to the upside out of that triangle. I also mentioned that triangles, when they break out, get retraced. Elliott wave triangles get retraced. Elliott talked about it all the time. The key is you don't know exactly when. It's kind of like a gap getting filled. The gaps are going to get filled. Sometimes they get filled immediately. Sometimes it takes a while. In this case, Bitcoin turned around and retraced the breakout immediately. In fact, we went past the breakout, moving all the way down to the support level here that you can see that is building at 48,000. So the move back to the upside today was a nice one, cementing that 48,000 in a good area of support. So now the question becomes, are we just going up to fill this gap? Are we going to run into some resistance at this 61.8% extension? Well, probably, because that's right at 60,000, which is resistance. So the chart of Bitcoin is pretty well defined right now. Support at 48,000, resistance at 60,000. So the fact that we came down here and we didn't retrace all of the C wave on that retracement of the triangle breakout still allows for the possibility of Bitcoin moving to the upside, completing that zigzag at the 100% extension up near 72,000. Got to get through 60,000 first, though. That's the key. Looking at the VIX, what was support is now resistance, right? You've heard that expression. So this area here around 20 that acted as support for so long on the VIX is now showing resistance. You can see that the VIX has come up, tested it a couple times, and look at that. We even have a doji on the VIX. So what does all this mean? Summary, I think it means Wednesday is going to be a very interesting day in the market, and it's going to go a long way to telling us what the next directional move is for the markets themselves. So I hope you enjoyed this. If you did, please hit that like button, or better yet, hit subscribe, and you'll be notified immediately when one of these recordings is posted. We really do appreciate it. Thanks for watching. Take care, everybody. Talk to you soon. If you like these recordings, I'd like to invite you to join our new Trade Finder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.